Samsung isn't buying silver by accident. In October 2024, Samsung SDI announced a $52 billion investment in solid-state battery production through 2030. That's not a typo, $52 billion. But here's what most analysts missed. This isn't a story about battery technology. This is a supply security play that confirms we've entered stage 3 of the silver supply cycle, a pattern that has played out identically in rhodium in 2020, palladium in 2000, and crude oil in 1973. While Samsung made this announcement, something else happened that nobody connected. The United States Mint suspended Silver Eagle production, the Canadian Mint moved to an allocation system, and the Perth Mint, known for 48-hour turnaround times, is now quoting 4 to 6 week delays. These aren't coincidences. These are stage 3 indicators. Industrial demand for silver has crossed 600 million ounces, the highest in recorded history. And when you look at Samsung's production targets, they'll need between 150 and 210 million ounces of silver annually by 2030. That's roughly 20% of global annual production for one company. This video breaks down the 3-stage commodity supply framework using verifiable supply data and corporate actions, not price speculation or market predictions. We'll examine exactly where silver is in this cycle, and what stage 3 to stage 4 transitions have looked like historically in other commodities. Because if the pattern holds, and so far it has, we're looking at a 12 to 24-month window before stage 4 begins. Before we dive into Samsung's strategy, you need to understand the framework. The 3-stage commodity supply cycle has repeated across multiple commodities over the past 50 years. It's not a theory. It's an observable pattern with consistent characteristics at each stage. Stage 1 is abundance. This is when supply exceeds demand. Mints produce unlimited quantities. Industrial buyers source from the spot market whenever they need material. There's no pressure to lock long-term contracts because inventory is readily available. Premiums stay low. Delivery times stay short. Everybody assumes this will continue forever. For silver, stage 1 roughly ran from 2010 through 2020. During this period, you could walk into any coin shop or call any mint and buy whatever quantity you wanted with minimal premium over spot price. The U.S. Mint produced Silver Eagles on demand. Industrial manufacturers ordered silver as needed, with standard lead times of days or weeks, not months. Stage 2 as deficit begins. This is when industrial demand starts exceeding mine production, but slowly enough that most people don't notice. Mints begin implementing allocation systems, rationing supply to dealers. Premiums rise gradually. Smart industrial buyers, the ones who've seen this pattern before, start securing long-term supply contracts. But retail buyers and smaller manufacturers still think this is temporary. Silver entered stage 2 around 2021. Solar panel production ramped up dramatically. Electric vehicle manufacturing accelerated. 5G infrastructure build-out increased electronics demand. Mine production couldn't keep pace, but the deficit was small enough that most market participants assumed it was just a temporary COVID-related supply chain issue. Stage 3 is crisis point. This is when major industrial buyers lock long-term supply, mints suspend production entirely, premiums spike dramatically, and physical availability disconnects from paper price. The buyers who waited too long are now competing for limited supply. The manufacturers who didn't secure contracts are now facing production delays or shutdowns. Based on multiple indicators we'll examine in detail, silver appears to have entered stage 3 in late 2024 and early 2025. But the critical question isn't whether we're in stage 3. The critical question is, how long does stage 3 last before transitioning to stage 4, and what does stage 4 look like? To answer that, we need to look at historical precedents. Rhodium is the most recent and clearest parallel to what's happening with silver right now. Rhodium is a platinum group metal used primarily in catalytic converters for gasoline engines. It's one of the rarest elements on Earth, and there's no substitute that works as effectively in high-temperature automotive applications. In 2016, rhodium was trading around $600 per ounce. Supply was abundant. Auto manufacturers sourced it from the spot market as needed. Stage 1. Between 2018 and 2019, global automotive production increased, particularly in China and India, where emission standards were tightening. Vehicles needed more rhodium per catalytic converter to meet stricter regulations. At the same time, mine production was flat. New rhodium sources take 7 to 10 years to develop, so supply couldn't respond quickly to increased demand. By late 2019, smart automotive suppliers began securing multi-year rhodium contracts. Premiums started rising, delivery times extended from weeks to months, but most market participants still viewed this as temporary, maybe a short-term supply disruption that would resolve itself. Then 2020 happened. South African mines, which produce about 80% of global rhodium, shut down during COVID lockdowns. Supply dropped dramatically, and simultaneously, automotive manufacturers restarting production all tried to secure rhodium at the same time. This is the Stage 2 to Stage 3 transition. By March 2021, rhodium hit $29,000 per ounce, not a typo, from $600 in 2016 to $29,000 in 2021. That's a 48 times increase in 5 years, with most of the move happening in the final 18 months. But here's the critical detail that most people miss. The paper price going to $29,000 wasn't the real story. The real story was that physical rhodium became unavailable at any price for buyers who didn't have long-term contracts. Automotive manufacturers who had secured supply in 2018 and 2019 continued production normally. Manufacturers who waited until 2020 faced production shutdowns. Some automakers reportedly paid premiums of 50 to 70% above spot price just to secure enough material to keep assembly lines running. The Stage 3 period for rhodium, from when major buyers locked supply to when physical availability completely disconnected from spot markets, lasted approximately 18 months. Now look at what's happening with silver. Palladium provides an even more instructive parallel because, like silver today, the transition was driven by a major industrial shift. In that case, the automotive industry's move to stricter emission standards. In the late 1990s, palladium was trading around $300 per ounce. It was used primarily in catalytic converters, and supply was dominated by Russian stockpiles left over from Soviet-era production. Stage 1. In 1999, Russia announced it would reduce palladium exports to preserve domestic supply. At the same time, new US and European emission standards required more palladium per vehicle. The deficit began, but slowly. Stage 2. By 2000, automotive manufacturers realized the supply situation was deteriorating. Ford, General Motors, and Toyota all began securing multi-year palladium supply contracts. GM famously locked in a 3-year supply agreement in early 2000, guaranteeing delivery at fixed premiums above spot price. This was the smart move that separated Stage 2 buyers from Stage 3 panic buyers. By 2001, palladium hit $1,100 per ounce, nearly a 4 times increase from 1998 levels. But again, the price spike wasn't the critical issue. The critical issue was physical availability. Automotive suppliers who hadn't secured contracts faced 6 to 9 month delivery delays. Some manufacturers redesigned catalytic converters to use platinum instead, which required retooling assembly lines at enormous cost. Smaller automotive suppliers simply couldn't get material and faced production shutdowns. The companies that secured supply in early Stage 3, when the pattern became clear, continued normal operations. The companies that waited until mid-Stage 3, hoping the situation would resolve, paid premiums of 40 to 60% above contract prices if they could get material at all. The timeline from Stage 2 entry in 1999 to full Stage 3 crisis in 2001 was approximately 24 months. Palladium eventually stabilized when manufacturers diversified into platinum and when Russian supply returned to markets. But the lesson was clear. Major industrial consumers who recognize Stage 3 early and lock supply avoid the crisis. Those who wait face operational shutdowns. Now let's look at where silver is today. Samsung's $52 billion announcement isn't about lithium-ion batteries. It's about solid-state batteries, which require significantly more silver per unit than current battery technology. Here's the math. Samsung SDI's stated goal is to produce batteries for 6 million electric vehicles per year by 2030. Each solid-state EV battery requires approximately 25 to 35 ounces of silver for internal connections, cathode conductivity layers, and thermal management systems. Let's use the conservative estimate of 25 ounces per vehicle. 6 million vehicles times 25 ounces equals 150 million ounces of silver per year. If we use the higher estimate of 35 ounces per vehicle, that's 210 million ounces per year. Global silver mine production is approximately 830 million ounces per year. Samsung alone would require 18 to 25% of total global production. But Samsung isn't the only player. Panasonic, LG Energy Solution, CATL, and BYD are all ramping up solid-state battery production with similar timelines. If we assume these manufacturers collectively target 20 million EVs per year by 2030, a reasonable estimate based on announced capacity expansions, that's 500 million to 700 million ounces of silver needed annually, just for EV batteries. That exceeds total current mine production. Now add solar panels. Solar manufacturing required 140 million ounces in 2024, up from 100 million ounces in 2020. Industry projections show this reaching 200 million ounces by 2030 as solar deployment accelerates. Add 5G infrastructure and electronics. This sector consumed approximately 260 million ounces in 2024. With continued 5G rollout globally and increased consumer electronics production, this likely stays flat or grows slightly. Add jewelry, silverware, and traditional industrial uses. Another 150 million ounces. When you add it all up, projected demand by 2030 exceeds 1 billion ounces annually. Current supply is 830 million ounces, and there are no major new silver mines coming online that would significantly increase production in the next 5 years. This is why Samsung's announcement matters. They're not speculating on silver prices. They're recognizing a structural supply deficit and taking action before Stage 3 fully manifests. But Samsung isn't the only indicator. In November 2024, the United States Mint issued a statement. American Silver Eagle production has been suspended due to lack of available silver planchets. The U.S. Mint doesn't speculate on silver prices. They don't care about market timing. They produce coins when they have raw material, and they suspend production when they don't. This suspension is a physical supply indicator, not a market sentiment indicator. The Canadian Mint implemented an allocation system in Q3 2024. Dealers can no longer order unlimited quantities. They're assigned monthly quotas based on historical purchase volumes. This is rationing. The Perth Mint, historically known for 48-hour turnaround on standard products, is now quoting 4 to 6 week delivery times. Again, this isn't about price. It's about physical silver availability. These are the same patterns that appeared in rhodium in late 2019 and palladium in early 2000. When government mints that have operated continuously for decades suddenly implement rationing or suspend production, it signals that physical supply is constrained at the wholesale level. Retail premiums confirm this. Historically, Silver Eagles traded at $1 to $2 above spot price. As of early 2025, premiums are consistently $5 to $7 above spot, and in some cases higher for smaller dealers with limited inventory. This is the physical paper disconnect that characterizes Stage 3. Paper silver, futures contracts, ETFs, unallocated accounts can still be purchased at spot price. Physical silver that you can hold in your hand or use in an industrial process trades at significant premiums and faces delivery delays. When major industrial buyers like Samsung need to secure 150 million ounces annually, they don't buy paper contracts. They need physical delivery contracts with guaranteed supply, and that's where the squeeze happens. Let's run through the Stage 3 checklist based on historical commodity patterns and see how silver compares. Indicator 1. Major industrial players secure long-term supply contracts rather than sourcing from spot markets. Samsung's $52 billion investment with multi-year production timelines requires secured silver supply. They can't risk assembly line shutdowns due to silver shortages. Check. Indicator 2. Retail mints implement allocation systems or suspend production. U.S. Mint suspended Silver Eagles. Canadian Mint moved to allocation. Perth Mint extended delivery times. Check. Indicator 3. Physical premiums diverge significantly from spot prices. Current premiums of $5 to $7 on Silver Eagles versus historical $1 to $2 represent a 200 to 300% increase in premium percentage. Check. Indicator 4. Corporate announcements emphasize supply security rather than cost optimization. When Samsung discusses their battery strategy, they focus on production capacity and supply chain stability, not silver prices. This mirrors GM's palladium strategy in 2000, where securing supply took priority over negotiating lower prices. Check. Indicator 5. Timeline from Stage 2 entry matches historical patterns. Silver entered Stage 2 around 2021 when deficits began appearing. We're now in year 4 of Stage 2, which aligns with the 18 to 36-month range observed in rhodium and palladium before full Stage 3 manifestation. Check. Based on these 5 indicators, silver displays all the characteristics of a commodity entering Stage 3 of the supply cycle. The question now is, what does Stage 4 look like? In rhodium, Stage 4 meant prices eventually stabilized at significantly higher levels than Stage 1, but physical availability returned as automotive manufacturers reduced usage through more efficient designs and some substitution with platinum. In palladium, Stage 4 meant long-term contracts became the industry standard, Russian supply eventually returned, and prices stabilized at triple their Stage 1 levels. But manufacturers who secured early contracts maintained cost advantages for years. For silver, Stage 4 likely means a multi-year period where industrial contracts define the market, retail availability remains constrained, and the manufacturers who secured supply in early Stage 3 maintained competitive advantages over those who waited. This is not speculation or prediction. This is pattern recognition based on 50 years of commodity market data. Samsung's $52 billion battery investment requires them to secure 150 to 210 million ounces of silver annually, roughly 20% of global production. When a company makes that scale of commitment, they don't rely on spot market availability. They secure multi-year supply contracts. When major industrial consumers begin locking long-term contracts while retail mints suspend production and implement allocation systems, history shows we're in Stage 3 of the commodity supply cycle. Based on rhodium in 2020 and palladium in 2000, the transition from Stage 3 to Stage 4 typically takes 12 to 24 months once major buyers lock supply. The timeline varies based on how quickly the broader market recognizes the structural deficit and how aggressively other industrial consumers move to secure their own supply chains. Understanding this framework is critical for anyone trying to navigate the silver market over the next 2 to 3 years, whether you're an investor, an industrial buyer, a manufacturer, or simply someone trying to understand what's happening in commodity markets. The pattern has repeated in rhodium, the pattern has repeated in palladium, the pattern has repeated in crude oil, and now the same structural indicators are appearing in silver. This isn't about predicting where silver prices will go. This is about recognizing where we are in a well-documented commodity supply cycle and understanding what typically happens next based on historical precedent. Subscribe to the Silver Framework for weekly analysis of supply data, industrial demand patterns, and stage progression indicators. We'll continue tracking Samsung's supply agreements, mint production data, and industrial consumption trends as this cycle develops. Because if history is any guide, the next 12 to 24 months will determine who secured supply in time and who waited too long.